This conference will now be recorded.
Hi, this is Brandon Cutrin here on behalf of Estate View Planning Software, and I wanted to go through the Crut and Nimcrut calculator and give a little background as to how these function and how you can use the software to illustrate the financial impacts of putting assets into a Nimcrut or a Crut. That stands for Charitable Remainder Unit Trust, or Net Income with Makeup Charitable Remainder Unit Trust. And there's a few differences between the two. I'm just going to use the Pro Plus module here. The Pro Plus will kind of show you the most details as compared to the standard or the Pro version, but anything that you find in Pro Plus would also be in the standard version. Standard obviously more simplified, Pro a little bit more complex, and Pro Plus the most complex. So a little brief background here. Charitable Remainder Unit Trust, or a CRUT, is a type of vehicle that you can put assets into that are expected to appreciate or that you anticipate to sell. And when that asset does sell, the proceeds would stay inside the Charitable Remainder Unit Trust. There would be no tax paid at the time of the sale. And as payments are made from the Charitable Remainder Unit Trust, tax is assessed at that time, depending on what you received. So as a hypothetical example, let's say we have $1 million of Apple stock. My basis in that stock is $1. Bought it when Apple first IPO'd. And if I were to sell that today, I would owe capital gains tax of $1 million at a 20% rate. I would pay $200,000 in tax, have $800,000 left to reinvest or spend whatever I decided to do with the asset. If I put it into the charitable remainder unit trust, I would get a charitable deduction for the contribution. And if you're maximizing what is coming back to the client or to the non-charitable beneficiary, that's generally equal to 10% of the initial contribution value. So I put it in the charitable remainder unit trust. It's valued at $1 million based upon our percentage payouts, which we can adjust, and I'll go through how that works with the software. The expected remainder value of that amount is going to be 10% of the initial contribution. So I get a $100,000 charitable income tax deduction. I sell the stock, stays in the charitable remainder trust. The full $1 million is invested. I diversify into a S&P 500 index fund that grows at 7%, for example, and I pay no tax until money comes out of the charitable remainder unit trust. What comes out of the charitable remainder unit trust is based upon the trust structure. So it could be for a term of years. Let's say it's for a term of 20 years, in which case the payout rate would be around 10.875% of the assets valued of the trust each year. So assuming I have, if I have no growth, just so I can make the math easy, in year one, it's valued at $100,000. $108,000, 10% would come out of that trust to me. I would pay tax on the $108,000, and the remainder would stay in the trust. We would repeat that same process over for 20 years. Whatever is left in the trust at the end of the 20-year period goes to a charity. And I've received 20 years of payments and have spread out my income taxes over that 20-year period. Or we can use what is known as a Nimcrut, in which case the payout percentage is the lesser of the stated percentage, the 10.875 I referred to earlier, or the income of the trust. And there's mechanisms that we can use to control the income. So it might be that we have the Apple stock that I used in my example held under a blocker LLC that we call it, that's owned by the Charitable Remainder Trust. And the Charitable Remainder Trust would not have income until a distribution is made from that LLC to the trust. So we sell the Apple stock, it's put into that LLC, we sell the Apple stock, it stays in the LLC. Every year, the 10.875% that's supposed to be paid out to me is tracked in what is known as a makeup account. So, for example, again, assuming no growth, just to make the math easy, $1 million goes in, first year goes by, everything's still in the LLC, so 108,000 that should have come out of the LLC is then stored into the makeup account. Next year, same process, $108,000 is stored into the makeup account. So now there's $216,000 under this makeup account. Year three, I make a distribution from the LLC of, let's call it $324,000. So my makeup account is then valued at $324,000, or sorry, $216,000. In the current year, my distribution from the Nimcrut was supposed to be $108,000. That's paid out. And then to the extent that the income of the trust exceeds the actual stated percentage that's supposed to come out, I can pull from the makeup account and distribute that amount. So in that year three, after I've deferred 2 years of payments that have been tracked in the makeup account, my income has exceeded the required payout, so I can pull from the makeup account and distribute the full $324,000 from the trust in year three. So we can work out how we kind of illustrate that to clients and how StateView software can help you describe those financial results. So going through a simple example here, let's say we have a just regular charitable remainder unit trust. I transfer it today on September 10th when I'm recording this video. We want to use the highest available rate based upon the 75/20 rate, which will help us calculate what is required to come out of the trust. It doesn't make much of a difference for a term, but if you use a life, so this could be for the life of an individual or for a term of years. We'll use a term in our illustration, and then that maximum percentage you can see here, if we use a 20-year term, is going to be 10.875%. Let's say we use lifetime. Just one life on a 60-year-old person, the max I can distribute is 13.38%. If I am older, I'm 65 years old, that goes up a little bit because I have less of a life expectancy, so what can come out of the trust is more. If I got a 50-year-old, we're going to have a lesser payout percentage, 9.07% in that scenario. So let's go back to our term, 20-year term. If I use a shorter term, then the payout rate increases, more can come out. The maximum that can come out in any year is 50%. The minimum that can come out is 5%. So you might have situations where if you're using 2 lives and you have two, let's call it 2 30-year-olds, let's see if this works, then the payout percentage of that would be 5%. So that barely satisfies the minimum. I'm guessing that the actual percentage is lesser than 5%, but we have to distribute out the minimum. In some cases, you may not even be able to create a charitable remainder trust in this scenario, but the software will, when we get into the illustrations, will show you that some of these just won't work, and you might have to wait a few years or redesign it to be a term or maybe on only one life as an example. So let's go back to our term for illustrations just to keep things simplified. Let's use a 20-year term. Let's say that we're going to pay out the maximum percentage. Our assets are going to grow at 7%. Our income tax rate, highest rate bracket, let's say it's 37%. We'll do annual payments, but you can also do monthly, quarterly, or semi-annual. Number of months before the first payment. We're in September, so let's say it's going to be 3 months from today to be the first payment. You can see how that impacts our payout rate schedule here. The trust value, we'll use $1 million, and let's not use a flip Nimcrut. I'll get to that example as we go through some of the illustrations. Time value money, what is this talking about? So how can we compare how the Crut would compare to just simply taking the Apple stock and selling it and putting it in our pocket? Well, if we discount the present value of the stream of payments that we're going to receive under the charitable remainder trust, then we can compare that to, if we discount it down to present value, how that compares to just selling the asset and paying the capital gains tax. So you can use whatever discount rate you want to apply on that time value of money adjustment. I'm going to use 5%. So as we click to see the results here, you can see that I have $1 million going into the trust, this contribution amount of $1 million. My payout rate is automatically calculated for me under the software to maximize the payout rate. You can change that if you wanted to minimize the payout rate to be, say, 5%. You can click up and down on that to adjust the payout schedule and the payout rate. What is my first year payment going to be based upon my assumptions? What is my reportable charitable remainder value? So what is my charitable deduction for funding this trust is shown here under the 7520 reportable charitable remainder, the expected value of my stream of payments according to the IRS, and then the total payments that I would receive, what's left over at the end of the trust, what are the income tax savings from this in the first year, and then again our present value calculations, which is the present value of the stream of annuity payments, is $985,000. So if I would have sold the Apple stock, paid a 20% capital gains rate, got $800,000, you can see that I am better off in the charitable remainder trust by deferring that tax, spreading it out over a 20-year period, and on top of that, I get the charitable deduction. So a Nimcrut can be a valuable planning tool to not only save income taxes, but also get more money in the client's pocket at the end of the 20-year term. Now, you don't get it immediately. You have to wait 20 years, but with the present value calculations, you can illustrate to the client those differences. So here, just to walk through the numbers, we have our beginning value of $1 million, the growth of the assets, the annual payment amount. So in the first year, it's a short period, so I'm not going to get the full amount, just a little stub payment. There'll be taxes paid on this payment as it's made. That decreases the value of the trust, and you can kind of see our present value calculations here on the far right-hand side. So the next year, the assets grow at 7% again, pay out the 11%. You can see our annual payment amount here. We actually pay that out, we pay tax on that amount, and then the trust value goes down. That process continues for 20 years until the end. So you can see at the end of the day that I've received a total of 1.5 million of payments based upon all these payments made here in this actual payment made column. The present value of those payments is 985,000, and then the remainder, what's left in the trust, this $450,000 goes to a charity. So the cool thing about estate view that you can do is you can say, well, what if we used a Nimcrut? So we can create different scenarios. So I'll go to Crut 2 now, just duplicated the same assumptions from Crut 1, but I'm going to go down and say I want to use a Nimcrut. And I want to defer this out for 15 years. Then I want to trigger it to make a distribution from my LLC or whatever mechanism you're using to control the stream of payments. And that's going to be in 15 years. We'll make that payment out. And let's compare the results of that to just a straight charitable remainder trust. So you can see here, the trust has $1 million. It grows in year one based upon the 3-month period. It tracks what should have been paid out, but it was not paid. So it goes into the makeup account. So 34,000 is booked into the makeup account. The next year, the beginning value of the trust, which is the $1 million plus the growth, since nothing was paid out, no taxes were paid, it continues to grow at that 7% rate of return that we've assumed. 11% of that is tracked as a payment. There was no income of the trust, so no payment is made. That's stored into the makeup account. And then the trust has the ending value that's growing at 7% because no payments have been made. And we do repeat the same process until we get to year 15, in which case you can see here we have almost 2.3 million stored in the makeup account. And we make a distribution from that LLC to trigger income being paid out. And then we also can convert the trust to a standard charitable remainder trust at that time, so that the next years it just pays out the 11% regardless of the income of the trust, which is typically how these things would be structured. One caveat here, you can see that the full makeup account is 2.3 million, but I only got to distribute 1.6. So why is that? Well, there's a rule under the Treasury regulations, which questionable whether or not that could still be valid under the new Looper case. It might be subject to challenge, but that's a topic for a different discussion. We won't go into those details today. But anyway, that Treasury regulation says that if I contribute an asset to the trust, the income from the trust cannot exceed the initial value of the asset contributed. So that $1 million of Apple stock that I put in here, $1 million is kind of the minimum level of whatever appreciation I have above the $1 million can be counted as income, even though state law principles may report income as a different amount. So we're limited to what we can distribute here, to the actual growth from $1 million. So the value of the charitable remainder trust has grown from $1 million to $2.4 million, which means we have around 1.4 of growth attacking on our growth in the current year, so maybe 1.6 of growth. So the most we can distribute is 1.6 million, and that leaves the end value at the initial contribution of $1 million, which is why part of the strategy is then to convert to a charitable remainder trust to pay out, whatever principal is left by using the charitable remainder trust, which pays out regardless of the level of income. So here we've tracked these payments for 15 years. We've made a large payment in year 15. We pay tax on that amount, and the ending value is $1 million, which then distributes us 11% for the remainder of the lifetime of the charitable trust. And charity ends up with $800,000. I've ended up with a total payment of $2.2 million. But I had to wait 15 years to get it. So when we back that down to present value, you can see that $1,020,000 roughly was our kind of present value of those stream of payments, which is better than just a straight charitable remainder trust. What if I just deferred this for 10 years? So we can go back to our scenarios. We can duplicate this, go down to our Nimcrut, say we only want to defer 10 years. And you can see there the differences between the two. I get a little bit less. Charity gets the end value, which would be 660 some thousand dollars. My charitable deduction is still the exact same in all of these, the $100,000 amount. And then from a present value standpoint, a little less beneficial than if I would stretch it out over 15 years. Obviously, with different growth rate assumptions, that could change. One might be more beneficial over the other as we change our growth rate, but that is the beauty of the estate view calculator and the Nimcrut calculators, that you can change those assumptions to anything that you like, compare them apples to apples, and illustrate this to the client. So then let's say we want to send this to the client. What are ways that we can do that? Well, a few different ways here. We can generate an explanation, which will give us all of these documents, a PowerPoint, a checklist, a short explanation. You can put in your firm information. So you just type in the client's name. We'll leave them as Bob Sample. I'm Brandon Petrin at our law firm, partner at Gaston, Roddy, and Polo. And my email. And I click submit, and that brings us out these general explanations. So you got the short explanation there. Go to my downloads, and I have this nice document that I can send to clients that gives a little background on what a charitable remainder trust is. We also have a checklist that can help you as a practitioner for what you need to do to set this up. Be careful with the assignment of income doctrine. Another substantiation of the charitable deduction is an important thing. Valuation is an important thing. Watch out for S corporations. Crut is not an eligible S corporation shareholder. It produces unrelated business taxable income, so you got to beware of those. If you have a non-charitable beneficiary that's someone other than the grantor or the donor, then you might have a gift tax return. So it's just a nice, helpful checklist to have there. And then we have a PowerPoint that shows how the payments work. So you get your 20 years of payments, remainder goes to charity. It gives you kind of your inputs and a summary of your assumptions, and then obviously your results. So that is the Crut calculator. A few other things I want to show you here that might be helpful is that you can also share this spreadsheet and share this part of the software, the screen, with your client. So you can click Share with Client button up here on the top. It gives you a passcode and it gives you a URL that you then can copy to your clipboard and send this password. You copy that, bring up an email to the client, and give a little short explanation as to what it is. Say, see this link, and it will show you the financial results of the Nimcrut. Allow them to actually manipulate the assumptions if they like. So change the values, change the rate of return, change the year of the flip, and all that can be done by the client if they're sophisticated and want to kind of look at the software themselves. You could also just hop on a Zoom call or go to my meeting and something like that and walk them through the screen. And you can also export to Excel. So if you want to, do something different with the numbers, at least you have a base of the numbers here. You can clean this up, put your firm's logo, make any additional columns that you like, put in notes and highlight items if you like, all in Excel. One other view here is just the timeline view, which shows the annuity amount coming out, the value of the charitable remainder trust, the growth, comparisons of the three trusts. So what am I getting over time versus what the charity is getting? And then like a logistical chart that shows, here's the trust today, here's the trust at the end of the term, and here's the value at the end of the term that's going to charity. So hopefully, and then you can change from 1 to 2 to 3 depending on which one that you would like to look at. You can see here with the Nimcrut, we have no payments and then a large annuity payment, and then the trust obviously would go down in value as that annuity payment is made, which is this orange column, and then the growth, same difference. Not going to have as much growth with less assets in the trust. So kind of some unique views that you can illustrate to clients if they prefer kind of visual charts versus mathematical Excel spreadsheets. Other thing you can do if you want to alter these columns, if you want to add additional things, such as like probability of death, if you're using a life term, you can show them, just go ahead and do a life term here. Let's go and say we're going to do a life term for a 60-year-old client that's going to pay out 13.55%. And if they're worried about, when is this expected to go to the charity? What does that look like? Well, you can show them here that at age 84, they have a 50-50 chance to survive and a 50% chance to die. That's based upon the IRS life expectancy tables. Our clients, wealthier clients, generally have a longer life expectancy. This is the average American taxpayers kind of probability and life expectancy. So it might be that they don't pass until 87, even though the life estimate is 84. But you can just show them the different percentages of probability of survival. If you wanted to run this out to show to age 100, we just change our assumptions for grantor year of death to age 100. You can see at age 90, there's a 26% chance. So that can impact, what's coming back to me versus what's going to the charity. Obviously, the longer I live, the more that comes back. The shorter I live, the less that comes back. The longer I live, the less there goes to charity. The shorter I live, the more goes to charity. So you can illustrate these things using the software. So that's kind of the calculator in a nutshell. Obviously, if you have any questions about how to use this, want some more materials on charitable remainder trust, we have other YouTube videos on those that are available on Alan Gassman's YouTube page. You can also email Alan or myself or anybody at Estate View if you have questions on a specific scenario that you would like to illustrate, or questions about how to use the software, questions about how to share this with clients, background on charitable trust. We're glad to provide that for you. So again, I'm Brandon Cutron on behalf of Estate View Planning Software. Hope everyone has an excellent day and hope you enjoyed the preview. Thank you.